There's something happening in the precious metals market right now that most people are completely missing. And I'm not talking about the headlines you're seeing. I'm talking about what's happening behind the scenes, the kind of moves that don't make the evening news until it's already too late to act on them. Gold just hit record highs. Silver is surging to levels we haven't seen in over a decade. And if you think this is just another rally that's going to fizzle out like we've seen before, you need to understand what's actually driving this move, because this time it's different. And I don't say that lightly. Let me show you what I mean. Central banks around the world are buying gold at a pace we've never witnessed in modern history. Not slowing down, not pausing, accelerating. These are the same institutions that have access to information you and I will never see. They're making moves that tell a very specific story about what they expect to happen next. And here's what should really get your attention. The commercial banks, the big players on the COMEX, they're positioned in a way that historically precedes massive price movements. When you see this kind of setup, when you see the smart money moving in one direction, while retail investors are still sitting on the sidelines, wondering if they should pay attention, that's your signal. But let me back up for a second, because I want to make sure you understand the full picture here. This isn't just about charts and technical levels. This is about fundamental shifts in how the global financial system operates. And those shifts are accelerating faster than most people realize. Think about what's happened over the past few years. We've seen currency debasement on a scale that would have been unthinkable a generation ago. We've watched as geopolitical tensions have fractured the post-World War II order that kept the dollar as the undisputed reserve currency. We're seeing countries that used to settle everything in dollars now making deals in their own currencies, in yuan, in anything but dollars. And every single one of those developments points in the same direction, toward hard assets, toward real money, toward gold and silver. Now, before I go any further, I want to mention something quickly. If you're watching this and you're thinking about how to protect your wealth in this environment, I put together a free guide that breaks down the saving secrets thousands of American retirees are using right now. It's in the description below. No cost, just practical information you can use. Worth checking out if you're serious about understanding what's happening. All right, let's get into the mechanics of what's actually happening in these markets right now. Because when you understand the structure, when you see how the pieces fit together, the picture becomes crystal clear. The COMEX, the exchange where most precious metals futures trade, is showing something remarkable. The registered inventory, the actual physical metal available for delivery, has been declining steadily. At the same time, the number of contracts representing claims on that metal keeps growing. You see where this is going? It's a classic supply-demand imbalance, but it's happening in slow motion, which means most people don't notice until the pressure becomes impossible to ignore. Here's what that looks like in practice. Let's say you're a major institution and you want to take delivery of physical gold, not paper gold, not a promise of gold, actual metal you can hold. Well, you put in your delivery request, and historically, that's been a smooth process. But lately, there have been delays. Premiums are rising. The spread between paper and physical is widening. These are the early warning signs of a market under stress. And it's not just gold. Silver is even more interesting because it has this dual nature. It's a monetary metal like gold, but it's also an industrial metal, which means demand is coming from two completely different directions. You've got investors buying it as a hedge against currency debasement, and you've got industries that need it for solar panels, electronics, electric vehicles, all the technologies that are supposed to define our future. The solar industry alone is consuming silver at rates that are eating into above-ground supplies. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. And here's the kicker. There's no substitute that works as well. You can't just swap in copper or aluminum and get the same performance. Silver's unique properties make it irreplaceable in these applications. So you've got industrial demand that's structural and growing. You've got investment demand that's responding to monetary instability. And you've got supply that's been relatively flat for years because most silver comes as a byproduct of other mining operations. It's not like miners can just decide to produce more silver when the price goes up. The economics don't work that way. Now let me tell you about something that happened that most people missed. There was a period not too long ago when the premium on physical silver coins and bars went absolutely parabolic. We're talking about situations where you could sell a futures contract for one price and buy physical metal for a price that was significantly higher. That's not supposed to happen in a functioning market. That's a sign of dislocation, a sign that the paper market and the physical market are starting to diverge. And when you see that kind of divergence, you need to ask yourself, which one represents reality? Is it the paper contract that can be created with a few keystrokes, or is it the physical metal that took millions of years to form in the Earth's crust and requires massive capital investment to extract? The answer should be obvious. But here's what makes this situation so interesting. The paper market has been the price discovery mechanism for decades. The futures exchanges, the LBMA in London, these are where prices get set, and those prices then flow through to the physical market. But what happens when that relationship breaks down? What happens when physical buyers are willing to pay premiums that make the paper price look irrelevant? We're starting to find out. And the implications are enormous. Let me give you some historical context, because this isn't the first time we've seen pressure build in precious metals markets. Go back to the late 1970s. Gold was trading around a few $100s an ounce. Silver was in the single digits. And then, over the course of just a few years, gold went to over $800. Silver went to $50. Those weren't gradual moves. Those were explosive. What caused it? A combination of factors. Inflation was running hot. Confidence in the dollar was eroding. And there was a physical shortage developing because industrial users and investors were both trying to secure supply at the same time. Sound familiar? Or look at what happened in 2008. The financial crisis hit, and initially, everything sold off together. Gold, silver, stocks, real estate, everything. But then something interesting happened. While stocks were still struggling to find a bottom, gold started climbing. And it didn't stop until it hit record highs a few years later. Silver followed, eventually reaching nearly $50 again. The pattern is always the same. Crisis creates uncertainty. Uncertainty drives people towards safety. And when enough people decide they want safety at the same time, prices move fast. But here's what's different this time. In previous cycles, you had one or two major drivers: inflation, or a financial crisis, or geopolitical tension. Right now, we've got all of them happening simultaneously. We've got inflation that's proving stickier than central banks expected. We've got a financial system that's more leveraged than it was before 2008. We've got geopolitical fractures that are fundamentally reshaping global trade and currency flows. And on top of all that, we've got central banks that have lost credibility. Think about it. How many times have we been told that inflation was transitory, that interest rates would stay low forever, that the system was stable? And how many times have those assurances turned out to be wrong? People are starting to realize that the emperor has no clothes. And when that realization spreads, when it moves from the margins to the mainstream, that's when you see real moves in hard assets. Now, I want to talk about something that doesn't get enough attention: the role of the dollar in all of this. For decades, the dollar has been the global reserve currency, which means countries around the world hold dollars as their primary reserve asset. They settle international trade in dollars. They price commodities in dollars. The whole system runs on dollars. But that's changing, and it's changing faster than most people realize. You've got countries like China and Russia actively working to reduce their dollar dependence. You've got the BRICS nations talking about creating alternative payment systems. You've got oil-producing countries willing to accept payment in currencies other than dollars. Each one of these developments taken individually might not seem like a big deal, but when you add them all up, when you see the pattern, it's clear that we're witnessing a fundamental shift in the global monetary order. And in that kind of environment, gold isn't just an investment, it's insurance. It's the asset that has maintained value through every currency crisis in human history. Central banks understand this. That's why they're buying. They're not buying because they think gold is going to go up 10 or 20%. They're buying because they need an asset that isn't someone else's liability, an asset that can't be printed or debased, an asset that will still have value no matter what happens to paper currencies. And here's something that should really make you think. When central banks buy gold, they're not doing it through the futures market. They're not buying paper contracts. They're buying physical metal and storing it in their own vaults. They want possession. They want control, because they understand that in a real crisis, paper promises don't mean much. You know, if you're sitting on retirement accounts worth $100,000 or more, this is exactly the kind of environment where you need to be thinking about diversification. I put together a guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description. Covers the mechanics, the benefits, the things you need to know. Worth looking at if this is relevant to your situation. But let me get back to what's happening in the markets right now, because there are some specific technical levels that are really important to understand. Gold has broken through resistance levels that held for years. And when you break through resistance that strong, it often leads to what traders call a measured move. Basically, the distance from the previous low to the resistance level gets added to the breakout point to project where price might go next. If you run those numbers on gold, you get targets that are significantly higher than where we are now. And that's just based on technical analysis. That's not even accounting for the fundamental drivers we've been talking about. Silver is even more interesting from a technical perspective because it tends to lag gold in the early stages of a bull market, and then it plays catch-up in an explosive way. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically high. And when that ratio starts to compress, when silver starts outperforming gold, that's usually when you see the most dramatic moves. We're starting to see signs of that compression now. Silver is moving faster than gold on a percentage basis. The ratio is coming down, and if history is any guide, this is just the beginning of that move. Now let me talk about something that most analysts aren't discussing: the energy transition that governments around the world are pushing. Whether you agree with the policies or not, the reality is that massive amounts of capital are being directed towards solar, wind, electric vehicles, battery storage, all of these technologies. And almost all of them are silver intensive. A typical solar panel uses about 20 grams of silver. Doesn't sound like much, right? But when you're talking about installing hundreds of gigawatts of solar capacity globally, those 20-gram increments add up fast. We're talking about hundreds of millions of ounces of silver demand just from solar, every single year. Electric vehicles use about twice as much silver as traditional cars. The charging infrastructure uses silver. The grid upgrades needed to support all of this use silver. And this isn't speculative demand that might materialize someday. This is happening right now. These are projects that are already funded, already under construction. And here's the problem. Silver mine production has been essentially flat for years. The big silver deposits were discovered decades ago. Most of the easy-to-mine silver has already been extracted. What's left is lower grade, more expensive to produce. And remember, most silver comes as a byproduct of other mining operations. So even if the silver price goes up, you don't necessarily get more supply unless the economics of copper or zinc or lead mining also improve. This is what's called an inelastic supply curve. And when you have inelastic supply meeting growing demand, prices have to adjust. There's no other way for the market to clear. But it's not just about supply and demand in the traditional sense. There's also the question of available inventory. How much silver is actually sitting in vaults available for purchase? And the answer is, not as much as you might think. A lot of silver gets consumed in industrial applications and never comes back to the market. It's used in tiny quantities in electronics, in medical devices, in thousands of different products. And once it's used, it's economically impractical to recover it. So unlike gold, where almost every ounce ever mined still exists in some form, silver has this constant drain from industrial consumption. The above-ground stockpiles are much smaller relative to annual demand, which means the market is more vulnerable to supply disruptions or demand spikes. And we're seeing both. Supply disruptions from mining operations that face environmental challenges, permitting delays, political instability in producing regions. Demand spikes from the industrial applications we talked about, plus investment demand that comes in waves as people wake up to what's happening. Let me tell you about a conversation I had with someone who works in the physical metals business. He told me that premiums on certain silver products have been elevated for months, not because dealers are trying to gouge customers, but because they're having trouble sourcing inventory. The mints are running at capacity, the refineries are backed up, and when you have that kind of tightness in the physical market while the paper market is still trading at relatively modest premiums, something has to give. Either the paper price has to rise to reflect the reality of physical scarcity, or the premium on physical has to widen even further, or both. And based on what we're seeing, it looks like both is what's happening. Now I want to address something that skeptics often bring up. They say, well, if precious metals are such a great investment, why don't they pay dividends? Why don't they generate cash flow? And it's a fair question, but it misses the point of what gold and silver actually are. They're not investments in the traditional sense. They're not businesses that generate earnings. They're money. They're stores of value. And the return you get from holding them isn't a dividend. It's the preservation of purchasing power when everything else is losing value. Think about it this way. If you had put money in a savings account over the past few years, what would have happened? Inflation would have eaten away at the purchasing power of those dollars faster than the interest could compensate. You would have lost money in real terms, even though your nominal balance went up. But if you had held gold or silver, you would have maintained or increased your purchasing power, not because the metals themselves changed, but because the currency they're priced in lost value. That's the whole point. They're the constant. The currencies are the variable. And in an environment where central banks are committed to policies that debase currency, where government debt levels are unsustainable, where the temptation to inflate away obligations is overwhelming, holding assets that can't be debased becomes crucial. This isn't speculation. This is risk management. This is understanding that the system we've relied on for decades is under stress, and having a portion of your wealth in assets that have survived every previous monetary crisis is just prudent. Let me give you another historical example. Go back to the 1970s again. If you were a retiree living on a fixed income, watching inflation eat away at your purchasing power, what could you have done? Stocks were going nowhere. Bonds were getting crushed. Real estate was okay in some markets, but required active management. But if you had allocated even a modest portion of your portfolio to gold and silver, you would have not only preserved your wealth, you would have grown it substantially. The people who understood what was happening, who saw the monetary instability and positioned themselves accordingly, they came through that period in much better shape than those who just hoped things would get better. And we're in a similar situation now, maybe even more extreme, because the debt levels are higher, the monetary expansion has been more aggressive, and the geopolitical tensions are more complex. So what does all of this mean for you? What should you actually do with this information? First, understand that we're not talking about getting rich quick. We're talking about protecting what you've already built. If you've spent decades accumulating wealth, if you've saved and invested and done everything right, the last thing you want is to see that wealth evaporate because you didn't account for monetary instability. Second, recognize that diversification isn't just about stocks and bonds anymore. In an environment where both stocks and bonds can decline together, where traditional portfolio theory breaks down, you need assets that move independently. And precious metals have historically provided that diversification benefit. Third, think about the difference between paper and physical. If you're going to allocate to this space, understand what you're actually buying. An ETF is convenient, but it's still a financial instrument that depends on the system functioning normally. Physical metal in your possession, or in a secure vault that you control, that's different. That's an asset that exists outside the financial system. And fourth, don't wait for confirmation from the mainstream. By the time everyone agrees that precious metals are the place to be, by the time it's on the cover of every financial magazine, the big move will already be over. The time to position yourself is when it still feels uncomfortable, when you're not sure, when the crowd is still skeptical. That's where we are now. The signals are there, the fundamentals are there, the technical setup is there, but most people are still waiting for more proof. And by the time they get that proof, the opportunity will have passed. Look at what's happening with central bank buying. These institutions don't move fast. They don't chase momentum. They accumulate slowly, methodically, because they're thinking in terms of decades, not quarters. And they've been accumulating for years now, consistently, relentlessly. That tells you something about their time horizon, about what they expect to happen. And if you're thinking about your own retirement, about the next 10 or 20 or 30 years, shouldn't you be thinking the same way? The financial system we've known is changing. The dollar's role is evolving. The relationship between governments and their currencies is being redefined. And in that kind of environment, The assets that have preserved wealth through every previous transition become more valuable, not less. This isn't about predicting the future with certainty. It's about understanding probabilities, about recognizing that the risk of monetary instability is higher than it's been in generations, and about taking steps to protect yourself against that risk. You know, for those of you who've made it this far, who've really paid attention to what we've covered, I want to mention something. That guide I mentioned earlier, the one in the description, if you check that out and you're an American retiree with at least 100,000 in retirement accounts, you can actually get a free one-on-one educational web conference. No obligation, just a chance to talk through your specific situation with someone who understands this space. Just mention you watched this video. It's only available to people who meet those criteria, but if that's you, it's worth taking advantage of. The bottom line is this: we're watching a historic shift in the precious metals markets, the kind of setup that doesn't come around often. The fundamentals are aligned, the technicals are confirming, the smart money is positioned, and the catalysts are accelerating. You can wait and see what happens. You can hope that the system stabilizes, that inflation moderates, that geopolitical tensions ease, that central banks regain credibility. Or you can recognize that hope isn't a strategy, that protecting what you've built requires action, that the time to prepare for a storm is before it hits, not after. The warning signs are flashing, the final call is being made, and what you do next could determine whether you preserve your wealth through what's coming, or watch it erode along with everyone else who waited too long to act. The choice is yours, but make it count.